Hello and welcome. In this video, I'm talking about certain common NRI financial confusions and misconceptions that I come across in the various forums that I participate in, answer the questions, and in dealing with the clients. Right. So I've just listed down some. It's not all, and definitely do please share other issues, things which you want videos on. So I'll make videos on those issues. So first misconception or the confusion is that the NREFT on return continues to be tax free, right? So basically, NREFT is treated as tax free. That is a big misconception. Even if it is tax free in India, it will be most likely be taxed in the country of residence, right? Because the host country, the country where you are a resident, will tax the NREFT. So NREFT thinking that it is a tax free investment is a big kind of mistake, right? Now, even in India, when you return back to India, you can continue the NREFTs till maturity. However, as per the exemption provisions which is given under the Income Tax Act Section 10, uh, the exemption is linked to the person's non-resident status in FEMA. And as per FEMA law, that you when you return back to India, you become a resident and you take up a business or a profession in India, you become a resident from the day one of your return. So when you return back to India, in such case, you the NREFT, the exemption provision gets lost. So that NREFT starts becoming taxable from the day of your return to India. This very few people know, because see, the bank will continue to keep it tax free for you till the time you maintain the NREFTs. Bank will not have a problem, because bank is not required to deduct any tax on the NREFTs. But it you as a resident as per FEMA cannot avail the exemption given by the income tax law, and you have to. So when you file your tax return, from the day of your return in India, you need to calculate the proportionate tax and offer that tax in your tax return for that particular year, right? So you need to be a bit careful about the NREFT thing. And the NREFT income, till the time you were in US, you or any other country, you should have been offering the income, FD income to tax in that country. Okay, then another misconception is that I can continue my non-resident account still the R0 status in India. This is a wrong notion. See, and basically, the residential status as per Income Tax Act is different. As per FEMA, it is different, right? Now, where from the requirement to redesignate non-resident accounts to resident accounts arise under which law? FEMA law, right? Now RNOR is a status under which law? Income tax law. So what you are doing, you are trying to mix both things, right? That is wrong approach. So as I said, when you are a non-resident and you return to India for the purpose of business, or for the purpose of employment, or for any other purpose which indicates your intention to stay back in India and not return back, right? You become a resident from the day one of your return. So the responsibility to redesignate the accounts start from that particular day. And the FEMA law gives you a reasonable time to make the changes. That means you have to make the change, make the NR NRE accounts back to resident accounts. You need to close your non-resident demat account, open a resident demat accounts, update the changes across all mutual funds, all those places. So you have to do all this within a reasonable time. Now, what is reasonable time has not been defined, but the penalties have been defined, right? So it's not that till it is there, till you are RNOR, you can continue your non-resident accounts. No, it is not like that. The RNOR status you may have 1 to 3 years, till 3 years also you may get the RNOR status. Doesn't mean that you can push it to 3 years, right? You need to start the process of conversion. Once you are back, and once your family has shifted, and you have taken care of the logistics and everything, then you need to get down to business in terms of your financial things, and starts kind of closing one by one things. Residential status as per ITR and FEMA is the same. This is again a confusion. So just briefly, I have made separate video on residential status as per Income Tax Act, right? And residential status as per FEMA. I have not made the video, so I'll make a video on that. So India says that there are three residential stages: non-resident, resident and not ordinary resident, and resident and ordinary resident. Right? There are three basically statuses in Income Tax Act. Now, these statuses are mostly on the days of stay, the number of days stay in India, right? And then there are other criterias also, that some income criterias are there, and some deemed residency criterias have been included now. As per FEMA, it is basically, again, there is a days, this thing 182 days and above. But the wordings of the, if you see the FEMA Act, the wording is that a resident is a person who is like 182 days or more in the preceding year, right? In the preceding year. But it does not include a person who has come for business, who is in India for business, profession, vocation. So if you read the FEMA law, the FEMA definition, it is more on the intent of that person. Also, the FEMA law uses the word reside. It doesn't use the word stay. The stay is there in the Income Tax Act. The case laws say that stay and reside have different meanings. Reside means some permanency has to be there, right? So FEMA is more on the person's intention, right? So for all practical purposes and for ease of understanding, understand, the day you move out to from India, you become a non-resident as per FEMA. The day you move back to India for the purpose of business, you become a resident. So both the definitions are different, right? Money, see, I understand the, it's a complicated thing, because the provisions, there is interplay of Income Tax Act, FEMA, then there is the Black Money Act, then there are, other, 4 5 acts are there. So I am trying to make things as simple as possible, a bit. Even if I make simpler, the purpose of the video is served. I just hope that I don't make things more confusing than what it may already be in your mind. So uh, uh, if you still have confusions on anything, please do share in the comment section. I will reply. Right? Okay. Money sent to India may be taxed. Now, a lot of people, they have this thing that if, for example, I'm an NRI, I'm sending money to India, it may be held taxable or not. See, let understand this. As a basic principle of law, India can tax only the income. India doesn't tax remittances, right? There may be certain countries who do tax remittances, but India is not amongst those countries. So India taxes it on income. Only one provision is there where India says that if Indian Income Tax Act says that if the money is directly received in an Indian bank account, it will be held taxable in India, right? So that is a one thing that you need to ensure, that you don't transfer the income directly into an Indian bank account, right? You receive the income in a US bank account or whichever country you are living in, and then from there you can transfer from that bank account to Indian bank account. Remittances are not taxable, even for the provision of when you talk about transfer of income. Now, in case of seafarers, there has been given a favorable kind of a concession by the department, where they say that if a seafarer, for a seafarer who is operating in like foreign waters, he doesn't have a bank account, you don't have a bank account in your foreign waters. So, and there you travel a lot of countries, right? And so what they do is that they credit into the NRE account of that person. So there were some judgments in 2016-17. There was a big controversy where they started saying that it is taxable in India because of that provision, that it is taxable in India. No. Then CBDT issued a circular number 3/2017, which said that for only seafarers, they gave the concession that if the salaries are transferred in the person's NRE account, it will not be taxed in India, right? Because it's not a Indian salary; it's a work that was done in foreign waters. You cannot tax it in India, so that exemption is there. But it is only for seafarers, not for people like you and me, right? So b- never transfer an income into an Indian bank account. Take it outside India, shift to India, but always preserve the documentation of the source of funds. Indian tax authorities have full right to check and ask what is the source of funds. Any credits to an Indian bank account, they have the right to ask, right? Okay, investing in India in residence. So now some people, there are certain restrictions under FEMA that you can buy this, you cannot buy this, and what people do is that they invest. Now there are certain restrictions in under the US tax law, if you see, there is a PFIC taxation, where if the person who is a US resident investing in Indian mutual funds or pooled investments will be subject to very high tax and reporting requirements and everything. So what they do is that they transfer the money to parents, and then and from parents account it gets invested. So basically, per se, it's a wrong practice, because see, understand this: India wants that whatever a non-resident, why India requires a non-resident to convert your resident accounts to non-resident, because it wants to track how much money is coming through non-residents, how much money is going out of the country, right? They want to track that. And if you try to circumvent all this by investing through resident parents names and all, you are basically exposing yourself to a risk of scrutiny. Some legal scrutiny can open up if you do this, maybe significant amounts, or maybe your luck is bad, right? Then understand one thing: if your return gets opened in a scrutiny, tax scrutiny, it there is no prohibition that prosecution or any other kind of a penalty cannot be imposed under other laws, right? So you don't kind of get any protection from that. So per se, it's a wrong practice. It's a very, very prevalent practice. Many people do it. Many people make the mistake that they do it, they don't even file the parents returns. Then the parents get the notices of, because there are significant transactions as per the applicable rules of the Income Tax Act, and the details get reported to the income tax authorities. They check that against that parent's name, the parent is not employed anywhere, he's not earning any income, but he's making so many investments in mutual fund. Then the parents get notice, then the parent has to explain that it is a transfer, a gift from my child to me, and all that thing happens. So uh, ideally, I will request you to desist from these practices because of the regulatory scrutiny and the risk in that. But final choice is yours. Not understanding host tax rules on Indian investments. Now, for example, best example as I discussed is the PFIC rules that US has for any foreign pooled investments, and not doing any pre-immigration planning. Pre-immigration planning is that if you are going to US, you should know how US taxes Indian investments. And if you have like mutual fund investments, you can completely eliminate those mutual fund investments before moving to US, so that you don't have any tax unrealized tax implications on that mutual fund. You don't have to report form 8621 every year for every mutual fund, right? You are saved from all that hassle if you plan your investments, if you consult the right persons beforehand, before moving to any country, right? So because from the time you get informed that you have to move to a country, you generally get at least 1 2 months, so you can do some planning there. You can even convert your accounts from resident to non-resident if you have the visa and all that available. And you can, if the bank or the institution allows you, you can even do that work before moving out of India. No need to preserve documentation. So you should preserve documentation for foreign income and assets, because that can be asked, and preserve them indefinitely along with the tax paid documentation. Income tax, Indian tax enforcement authorities wouldn't question the fund transfers. So please understand here, this is again a misconception. If the only fact that you are a non-resident doesn't allow you, it doesn't give you any immunity in terms of that the Indian tax authorities won't question any fund transfers to your accounts in India. As soon as the money hits to any Indian bank account, it may be an NRO NRE account also, right? They have the right to question it. Also, there is a significant transaction reporting, because of above a certain amount, the transaction has to get reported to the income tax department. So you need to preserve the explanation of the source of funds, even if the income arises outside India, right? Okay, in case of double tax, so here, see, understand the general principle here is that mostly, and this is just general rule, there are exceptions. Generally, if an income tax department says that this income that you have transferred, say 25 lakhs in your NRI account, it should be taxed in India, the onus is on the assessee to prove that it is not. And how will the assessee prove? First is by the way of the passport entries, right? That I was not a non-resident for that period. You can see my details. Then the employment contract, then the income, the W2, that the or the salary statement, the bank statement, right? So all that you need to have to prove that the income has arisen because of your employment out of India, and your status was that of a non-resident. That's why it should not be taxable to you in India. You cannot then say that no, the onus is on the department to prove that it is taxable to me in India, right? So okay, in case of double taxation, this is a misconception that you can claim a credit of the foreign country tax in India and the DTA relief. Now, understand that see, there are foreign tax credit provisions in case of double taxation, uh, which arises if you are a resident of US and your income is in India. India will tax the income. US will tax the same income. There is double tax, and there is a DTAA, and there are the foreign tax provisions of each country. So there, please understand, there are lot of ifs and buts in the DTAA, and there are lots of ifs and buts in the foreign tax provisions of the country's internal tax law. So you may think that a income on which the tax has been paid, it may be the tax will be the double tax will be removed. No, practically it doesn't happen, because both the countries' law, like India gives the credit of the lower of the Indian tax and the US tax. US in turn gives credit of only the proportionate amount of the Indian tax, which to the proportion of the India tax versus the total India income versus the total income in US. So all those ifs and buts you need to keep in mind, right? So you have to align your finances in such a way that double taxation should not arise, can be reduced, and if it then arises, then you need to take recourse to the in the best way, either the foreign tax credit provisions or the DTA provisions. No need to declare foreign income assets in Indian tax return which qualify as a foreign country tax resident as per DT. So this is again this is a complex situation that arose in one of the cases. Is that if you are a resident, I will make a I've made a separate video on this. I will post it. Basically, you are a assume you are a tax resident of US. You also have spent more than 182 days in India, so you become a tax resident of India. So in India tax return, you have to file the income to tax. But what if, as per the DTAA Article 4, you there's a tiebreaker clause, you tiebreak to US, right? Your residency is US. Does that mean that in the Indian tax return you file as non-resident? No, because India has a black money law section. Black money law, in Indian black money law, it says you have to an Indian resident, as per Section 6 of the Income Tax Act, not at the DTA. As per Section 6 of the Act, you are a resident and ordinary resident. You have to disclose foreign incomes and assets in schedule if FSI and FA. If you don't disclose, there's a flat 10 lakhs penalty. So you need to take into account those cases where if you're tax resident of both countries and you tie back to a particular country, in the other country you still have to file everything and then claim the benefits within the tax returns. So it's a tricky case, but this is again, these kind of confusions are there in case of multi-country incomes. Now, this is what I very commonly see is that people, for these kind of complex tax and financial queries, relying on online articles. See, everything cannot be resolved online. Everything cannot be resolved by online, searching for articles or chat. Some people even they check answers in chat gpt, and they post on forums also chat gpt answers, and then I see them from the face of it, I can see that it's from a chat gpt, and the answer is also completely incorrect. I don't know how chat gpt also has got it must have checked some 10 sources and got the answer completely incorrect. So please don't, for for these things, for these complex queries, please consult proper professionals who are experts, who know about the cross border implications, right? And then there's one more thing, that you may be always having a CA who is like a, when you were a resident he was filing your tax return, but then when you talk about moving to US and lot of things are involved in cross border thing, so that CA may not be knowing those provisions. So you need to check a CA or a CPA, whoever you consult with, whether that person has expertise in the that particular cross-border aspects and everything, right? So not everyone will have full expertise of everything, but at least someone can be more knowledgeable on a particular aspect as compared to other person. So you need to search the professional also that you are consulting, you need to be, search that them well, and not rely on that same CA or the same person who was filing your tax return earlier, because now the complications are more. No need to keep in mind foreign country tax rules after return. No. So if you return to India, you keep your in US investments. I've made a separate video on how to points to keep in mind on keeping US investments after return to India. So you need to also stay updated with the foreign country tax rules, or have a CPA in that country whom you can call up and speak before making any financial decision on your investment, because even after return to India, those provisions will still apply, and the added complexity of will be of the Indian provisions. So you need to have a CA in India who has an expertise in the cross border tax aspects. You also need to have a CPA in that particular country where your investments are located, right? If you don't want that headache, or if you are not ready to pay the fee, what my suggestion will be to have all your investments in India. Bring all the money in India, have the Indian investments, rather than making those costly tax mistakes and paying extra tax. Because I find a lot of people making those mistakes, not filing W8B and having backup withholding tax deducted in US, and the amount of money going down the drain, because there are certain things you cannot claim back in India also. You have to file those 1040 NR, and then there is another process for that, right? So think about these things. On becoming so one misconception is, on becoming ROR, India will tax income from foreign investments on the same lines as the foreign country does. Don't have that misconception, because India will totally disregard the tax advantage nature of investments like 401k, IRA, Roth IRA. So, for example, traditional IRA, in, income is taxable on withdrawal, right? India doesn't subscribe to that. For Roth IRA, it's invested through post-tax dollars, and then there is no kind of taxation on withdrawal. India does it. We don't care what is the Roth IRA provisions in US. We will tax as per our local law. So every country follows the same approach. US will totally ignore Indian PPF, EPF, NPS, all the tax advantage nature of those instruments, NRE, FDs. US will say pay tax, right? I will not, kind of consider whether your that country gives a exemption. Only thing is, you can check the DTA, whether in DTA certain investments get like US Canada, they have a tax relief for the Canadian RRSP, right? But in India, the India US DTA is very weak, right? So you need to clear that misconception. Then final point is that not understanding real estate investment risk, right? So real estate investments, people think it's a very good option, but please also see the stress and the hassle with respect to managing the investments in India, the black money that is involved, right? When you sell, when you purchase, at both times, other compliances that come through, right? Then there are other risks such as currency risk, immigration risk, estate risk in financial planning. So all those things you need to keep in mind before having these kind of multi-country type of investments. So these were only some of the points. I hope some of the points clicked with you, gave you some perspective. If you have any comments, thoughts, do share it in the comments section. Thank you so much for watching this video. Thank you. Bye.